what's 118 PE? This is 50. That's big growth.
That's huge.
Volatility, baby. That's volatility. Guys, can you withstand that? AMD, guys, Advanced Micro Devices. This company is it's for the last 25 years has been just nipping at Intel's heels. A lot of companies have been. The chip industry is going through a lot of changes right now. Massive, massive demand that occurred in the last few years after COVID. Now that demand is waning, revenue's coming down a little bit, but AMD is a company to pay attention to. They make great chips, absolutely great chips. But let's look at AMD on our software and check out this amazingly insane. Look at this. So back in 2000, it hit $45 a share. It's currently at $96 a share. So in the last 23 years, it's only doubled. But in that time period, look how low it got. Oh, how low did it get? $2 I see in 2016.
16, yeah.
$1.82 in 2015. Wow. Guys, can you withstand that? That is a 95%, 98% drop in stock price before it skyrockets back up, hit an all-time high of $165 back in November of 2021.
That was big. That was when stocks were flying big, and then they weren't.
Volatility, baby. That's volatility. Now,
look at that peak right there that was created between 2020 and 2022. That is a vicious move if you're a stockholder.
Yeah, vicious. You know what's a vicious move? When you bought it right here, and it was at $1.50 right here. 15 years later, you lost 95% of your money. It's hard to stick with the company. It's really, really difficult to do that. So let's check out some high-level things on AMD. First off, gross margin 43%. Not bad.
No, not bad.
Not bad for a chip business,
Profit
right?
margin's terrible.
Profit margin's bad, but that makes sense because they're really. Here is the ugly part. 1 year PE of 263, 5 year PE of 103.
Yikes.
Yikes is right. Mo, look at their 8 pillars.
Is it going to be bad?
Shares outstanding. This is what I knew was going to be here. Now, guys, remember, if you have our software, you can do the custom 8 pillars. You actually can do up to 12 pillars on your own. Trillions of different options. Mo has his own.
Yeah.
I just keep the regular ones on here, but 61.8% more shares. What does that mean, Mo?
You know, it's funny. Every time I see AMD, I always forget about that.
That's the huge thing about AMD. They had to, guys, you can fund a business 2 different ways. Borrowing money or putting equity in. This is putting equity in. You're selling more shareholders.
Yeah.
The problem with it is if you owned the shares 5 years ago, you've been diluted now by 60-some%.
Exactly.
That's the problem. You have way more partners now than you originally wanted.
For the same shares that you have.
Correct. Now the revenue, profit, cash flow, everything is being split among 62% more people today than it was 5 years ago. That's a big difference. Yeah. That's something that's a silent killer in investing.
Yeah, it's going to diminish your returns.
Absolutely. For example, if the company was up 62% in the last 5 years on revenue and 62% in profit, you'd be like, that's awesome. But if they did this, you've seen zero gain.
Nothing.
Because now that revenue and profit is being split by 62% more people. So you've seen zero net gain to yourself as a shareholder. There are a lot of investors out there who won't even buy a company if their shares are up over the last 10 years, the number of shares they have outstanding. Go back 10 years ago. Let's go look at this our software income statement. 10 years ago, AMD had 761 million shares outstanding. They have 1.62 today. So they're up over double number of shares in the last 10 years. That's ugly, guys. That alone gets me to go, hang on a second. What's their plan here?
Yeah.
You know what they're saying here? Our stock is expensive as that. By the way, their stock wasn't even, it was $1.50 here.
Exactly.
$1.85.
Exactly. They didn't really have this big boom until recently, until kind of COVID.
Yeah.
Maybe a little bit before COVID.
That's nuts.
Yeah.
So let's go see what analysts are saying about the company.
A couple things worry me about this company.
Oh, let's hear it.
Well, first of all, look at the income statement. Look at the revenue. I mean, they were doing single-digit billions revenue, and then all of a sudden they jumped to 11 billion, 18 billion, 23 billion. That's scary.
So let's see.
I don't think that is sustainable just looking at these numbers. Nothing has really fundamentally changed in the business between 2018, 19, 20 that gives them more than double the growth. That's kind of the thing that I see there.
That's interesting, Mo. They've had some acquisitions. No, they had one acquisition. Okay, so now they actually sold off parts. All right, so back to analyst estimates here. I mean, This is some pretty big growth in EPS, and it makes sense for a company that went before with reinvesting a lot, having a lot of depreciation. Okay, they're taking a lot of market share away from big players. Got it. This could be, I have two PC laptops. One's Intel and one is AMD. I think they're both great.
Yeah.
I just don't know which one is better, but I look at this going, okay, this is big growth. Now, keep in mind here on our analyst estimates, there's only 2 people making estimates over here for 4 years out. And they probably want to get some business from AMD, so they're probably being optimistic. Let's look at the revenue growth. Now, I read a report last year that said that the compounded annual growth rate in the chip industry is 12% a year for the next 10 years. That's big growth.
That's huge.
And guys, it makes sense. As the world becomes more and more technologically driven, you have to have more chips. It's just a reality. You have to have more chips in order to back up all these I mean, look, Mo, how many computers, phones, and all these things do you have?
Two computers.
You have a lot. That's the point.
2 laptops. I have a lot.
iPads.
Yeah, I have multiple iPads and
Yeah.
yeah.
That's the whole point.
It's a lot of chips.
20 years ago, you might have had one of those things.
And then I didn't really think about this until the supply chain issues happened, about how many chips are in your car. Like to move your seats and do all of these different little quirky things, not just the GPS system. I didn't really think about all those things before we had supply chain issues. It's a lot of chips.
Chips are important.
Yeah.
Chips are important.
Yep.
All right. Revenue, again, growth of double digits, not going out very far. We only have analyst estimates here going out 3 or 4 years, so keep that in mind. Now, the question becomes a stock analyzer tool. So, guys, this tool has been used by was used 1.3 million times last year by our software users. If you like the software, if you like all the potential tools, if you've watched our videos and you've seen this, $7, 7 days, $1 per day, try it out, no brainer. Imagine all the things you spend $1 a day on or more. This swing will just change the way you look at investing, right? It's a game changer. So everythingmoney.com, check it out. Now, I'm going to do a 20-year analysis. Mo is going to do a 10-year analysis. Now, I will say my big caveat for this, Mo, is what? Number of shares outstanding.
Number of shares, yeah.
I don't know what they're going to be doing with number of shares outstanding. Are they going to dilute the heck out of people, the heck out of their investors going forward? I don't know.
I will say, I think that dilution number shows that they don't care about their investors. They're more they will do whatever they have to do to get where they want to be.
That might sound like a harsh statement from Mo, but you look at the actions of the corporate world, of the board, and say, why are they diluting everybody? Now, Mo, the reason that bothers me is when they were at $1.60 a share, they were still issuing shares to fund their growth.
Right. It's not.
What?
It's not like they just took advantage of a situation. This is just what they do.
Yeah, and that is concerning. So our assumption here is that the number of shares outstanding stays the same. Mo's going to do 10 years. I'm going to do 20 years. We're going to have a wide range of assumptions, though, because we don't know where AMD is going.
Yep.
Look at a company like Intel does $70 billion in revenue. AMD is doing $20 billion. So they have a lot of growth potential.
Right.
Or it could be like this growth potential has been big on AMD for 25 years.
And especially in the last couple.
Yes.
I mean, that's what worries me.
So we have to be wide range, and that's part of the art of investing. You don't know, there's a wide range there. And the further I go out, the wider that range becomes. Think about it. If you shoot a shotgun, where is it widest? It's closer as you go out in time closer, right? You got 20 years, look how wide that range is. But that is the art of investing. And that's why we're here creating this channel to teach people that investing is an art. And it has to be based on some fundamentals, but it's an art. So hang on a second, we'll be right back. Okay, so here we are now. Quite the range, but I'm gonna explain some numbers here to show you how the range makes sense. 20-year analysis for me, 10 for Mo. My revenue growth numbers, 6, 10, and 14%.
I did 4, 8, and 12.
Okay, so I wanna show you guys what 14% a year for 20 years does. 1.14 to the 20th power times 20 billion. It takes them to $275 billion in revenue in 20 years.
They did 23.6 last year.
They did 23 points, so it's even higher than that, about $300 billion in revenue. So just keep that in mind. It's not something like, oh, it's going to grow $2 billion a year. No, it really compounds on itself.
Right.
This is a very, very high number. Like I said, Intel is doing 70 billion.
Yeah.
Okay? Keep that in mind. All right. Profit margin. Mo, what'd you do?
Profit margin and free cash flow margin, I did 5, 7, and 9.
So I did 6, 12, and 18. Okay. Here's why. If you remember, during Intel's peak, they were making about 21% bottom line profit margin.
Yeah.
So I was like, okay, as AMD grows,
They can match it.
Yeah, and they can add that bottom line, keep getting that gross margin. I don't think this is an unreasonable estimation. I'm like, okay, great.
All right.
I'm more concerned about the 14% than this.
Yeah.
right?
Yeah. Going back to revenue, I like your revenue numbers. I also like mine because mine are closer after that crazy growth. Maybe there's a slowdown and then a peak. I think we're on the right page.
This is the art of investing.
Yeah.
Free cash flow margin, I did the exact same thing.
15, 17, 19. Yep.
Free cash flow margin.
Oh, free cash flow margin. Sorry.
Yeah.
If I did 579,
Yep, I did 612. Now, PE, you did 15, 17, 19. Same with me, and same with the free cash flow. Now, you guys might be looking at this saying, well, this is 118 PE, this is 50. The analogy I'd give you is great. My house is for sale for 10 million. Oh, you don't want it? Fine, it's 5 million.
50% off?
50% off. It's a deal now. No, it's still overpriced. It's still not a $5 million home. That's the key here. Just because of this, don't be Meet Kevin, who says that 70 PE on Tesla is reasonable because their history has shown 200 PE. He is stupid. Do not be stupid. All right, desired return.
10, 12 and a half, and 15.
Look what I did. I did 10, 14, and 18.
I don't blame you.
Because, guys, this is going to be the hard part right here. That 14% revenue growth is going to be very, very difficult. I really want to see that. Now, I hit the analyze button. The stock is currently at 96. Boom. I have a low price of 18, high price of 60, middle price of 40. Mo, what about you?
I have a low price of 11.66, middle ground of about 20, and 30 on the high side, watch list at 40.
My watch list is 45. So guys, that's investing for you. We appreciate it. Again, everythingmoney.com, set $1 a day for 7 days. Try it out.